Everything begins with a vision, a project, a product, or a service. Nobody has ever done it before. Unbelievable. It's blatantly clear. Will you be able to pull it off? Perhaps you and your two friends are excited. Create a logo. Create a name. It's all in good fun. Create a concept. Things become serious. You decide to incorporate this. You must create a legal structure. How much will that cost you in the United States? Incorporating a business will cost you anywhere from $25 to several $1,000s. That includes registration fees, which vary greatly depending on where you live, and legal fees, which vary according to how tight your initial shareholders' agreement needs to be. Your company turns out to be on the expensive side. In order to create your product, you will also need to rent a server. As a result, you decide to start collecting money from other people now. Who on earth would lend you money for your venture? It will be obtained through family, friends, or crowdsourcing. It frequently includes company difficulties, such as 100,000 shares with equal ownership. You must pick who will receive how many of those. You decide on 40,000 shares, or 40% of the company, for each founder, and 20,000 shares, or 20% of the company, for a family friend who pays $50,000 for them. It's referred to as an investment, and it's known as a seed investment because it comes at such an early stage in your startup. The money he pays is now owned by the firm. If the company fails in the near future, which is statistically the most likely situation, you will most likely never see another dime of it. $50,000 for 20% of the company values your business at $250,000, which values your 40% at $100,000. Not too shabby. Please sign the petitions here, here, and here. Congratulations, you formed your company and completed your seed round of funding. It's been a year. You're doing a successful beta test with clients. It's time to hire some additional workers. Rent a small office space as well as a server. You could only go so far with $50,000 in seed cash. It's time to gather your first large sum of money. This will be done in a series of rounds. You're looking for a $1 million investment. This time, you'll be contacting angel investors and venture capitalists, VCs. VCs are employees of venture capital firms that raise venture capital funds. They take other people's money and invest it in young, risky businesses like yours. Angel investors are individuals that invest their own money in emerging enterprises on a regular basis. They previously sold their own startup and are now looking to support Burr Ventures. You contacted a couple venture capitalists and angel investors. Some of them you found online, while others you met through friends and coworkers. You sent them emails and a business plan. Typically, they are uninterested in the business plan. They want to know if the squad is capable. Is the concept unique? They understand how difficult it is. What achievements have you already made? Is it encouraging? What could you accomplish? Can you imagine big things? You schedule some Skype calls, some small talk, and a lot of business talk. Easily describe the vision. We've done it dozens of times by now. They interrogate you with challenging questions. Have you heard of another startup that does something similar? What distinguishes you? You stimulate people's interest, and then you get second and third calls. You actually meet them. They may devote time to discussing valuation. There are two types of valuation: free money valuation and post-money value. Your startup's pre-money valuation is how you now value it. The pre-money valuation is increased by the post-money valuation. The investment you want to collect is usually the one you utilize while negotiating, because the investment divided by the post-money valuation equals the investors. Investors who wish to invest in your firm desire a low post-money valuation so they can gain more for their money. To keep a larger share, you desire a high post-money valuation. You propose an $8 million post-money valuation for the investor who puts in $1 million. This would imply a 12.5% share in your company in a few weeks. There are two competing bids on the table. One VC provides $1 million investment for a post-money valuation of $6 million. An angel investor you speak with proposes to invest $500,000 for a post-money valuation of $5 million. The venture capitalist's offer appears to be the superior deal, but the angel has extensive industry contacts. It's known as smart money. What are you going to do? You decide to go with both options. You inform the angel that you have a $6 million post-money evaluation standing offer, but you would really like to have her on board. She agrees to invest in a post-money evaluation worth $6 million. Great. How does the cake divided this time? Let's do some maths. The VC and angel will invest a total of $1.5 million in your company for a post-money valuation of $6 million. This means they will own a quarter of the corporation. Before you brought on new investors, you, your co-founder, and a family friend each owned 100% of the business together. Following the Series A investment, you will be diluted. Your total stake in the company will be merely 75%. This dilution occurs in a proportional manner. As a result, you now have fewer shares. No, this is how it works. When you incorporated your firm, it issued the initial 100,000 shares, and it will now issue more shares for new investors to purchase. The corporation has the ability to issue shares. A central bank, for example, can print money. The overall number of shares in the corporation only fluctuates, while your share count remains constant. What is the total number of shares issued by the company? If 100,000 shares now represent only 75% of the corporation, 100% ownership will be comparable to 133,000 shares. As a result, the investors receive 33,000 newly issued shares in exchange for their investment. Because they paid $1.5 million for their shares, each share is now worth $45. Your 40,000 shares are now valued at more than $1.8 million. Congrats! A capital raise refers to the entire process of a firm issuing new shares in order to obtain cash. If all goes well, the Series A will not be your startup's final capital round. Each investment round will have a Series B, Series C, Series D, and so forth. Hopefully, the company's valuation will rise as well. You will be more diluted each time your company raises fresh funds from investors. Remember how I stated your share count would remain the same, even though I lied? Actually, stock splits are common along the way, converting each single share held into multiple shares. As a result, your share count is quadrupled or tripled on a regular basis, along with everyone else's. The goal of this and many other things are determined in the term sheet is a story for another time. You're not interested in legal work anyway. Your primary concern is the expansion of your company, which is currently on track to reach new heights. Your company has been in operation for 6 years. Since then, you've successfully executed 4 investing runs. You should have launched your product by now. What do you think? Customers enjoy it. You've had a tremendous amount of success. The large chunks include information on you and other things. Most significantly, your company did not lose money for the first time last quarter. The company generated a profit, so it was time to go. When investors discuss exiting the company, they are referring to the sale of their shares. Everyone who has put money into your company since the beginning has been discreetly hoping for a great payoff. The earlier they invested, the more the risk they took, and hence the greater the payoff if the company truly takes off. There are typically 2 ways to leave a company: sell to one of the big boys or list it on the stock exchange. When you sell to a large corporation, the investors normally sell all of their shares at once. You and your coworkers, on the other hand, are unlikely to. Whoever buys you wants you to stay motivated in order to operate the entire operation. As a result, your shares will be converted into shares of the firm that purchased you and made available to you over time. This is known as vesting your shares. If you quit early or fail to meet certain agreed-upon milestones, you will not receive all of your shares. The much cooler method to exit is to get large enough to be able to sell your company's stock on the stock exchange. This is known as an initial public offering, IPO, or insured IPO. And what exactly is an IPO? What exactly is an IPO? I still don't know what an IPO is, and don't trust Martin Stacey when he says how it works is painfully simple. In essence, an IPO is merely another way to raise funds. Your corporation will issue fresh shares once more. The only difference this time is that the buyer is neither an angel nor a VC. It's the general public. Your company issues a large number of new shares to the stock market on the day you go public. People can then buy and sell them amongst themselves. Furthermore, you now have tradable paper that is nearly as good as cash, which fluctuates in price on a daily basis, with the exception of IPO lockup periods, which are discussed further below. You can sell your stock into the stock market at market price at any time. You offered the shares for sale at a starting price of $64, and they jumped to more than $70 on the first day of trading thanks to stock splits you performed along the way. You now own 10 million shares in your corporation. Your personal fortune exceeds $700 million. You could make money, but do you want to? It seems like only yesterday that you too had a vision. You're now 1 in a million. Even though investors label it an exit, you accomplished a lot and still have a lot to do. For many entrepreneurs, this is just the beginning. That's all for today. If you enjoyed the video, make sure to subscribe to our channel Lux Mindset and don't forget to hit the bell icon.